Welcome back. In this section, we'll take a look at the most common depreciation method, the straight-line method. You can think of an asset's acquisition cost as a prepayment made in advance of the future use of an asset, similar to how insurance or airline tickets are purchased in advance and not recorded as expense until they're used. Depreciation is the process of allocating the cost of a plant asset to expense in the accounting periods in which it's used. Depreciation does not measure the decline in the asset's market value each period, nor does it measure the asset's physical deterioration. Since depreciation reflects the cost of using a plant asset, depreciation charges are only recorded when the asset is actually in service. You should recall this discussion in part from Chapter 3 when we discussed that depreciation was a special type of adjusting entry. Do you recall the journal entry to record depreciation expense? Please review your Chapter 3 notes if not. Remember that the credit side of the entry is recorded to the contra asset account called accumulated depreciation. And accumulated depreciation has a normal credit balance, and we can think of it as sitting right next to or married to its related asset account in the general ledger. Now, as a reminder of what we covered previously in Chapter 3, both the cost and the accumulated depreciation of plant assets are reported on the balance sheet or in the footnotes. Accumulated depreciation means exactly what it says, the amount of depreciation accumulated since the beginning of the lives of the assets that remain on the books. Often, accumulated depreciation is reported in one lump sum amount on the balance sheet and detailed out in the notes for easier reading. Reporting both the cost and the accumulated depreciation of plant assets helps users compare the assets of different companies. And finally, remember that plant assets are reported on the classified balance sheet below current assets. Factors that determine an asset's depreciation are number 1, the cost, number 2, the salvage value, and number 3, the useful life. The cost of a plant asset consists of all necessary expenditures to acquire it and prepare it for its intended use. Total depreciation expense will be equal to the asset's cost minus its salvage value. Salvage value, which is also called residual or scrap value, is an estimate of the asset's value at the end of its useful life. It's how much we expect to receive from disposing of an asset. It's the trade-in, the sale, or the scrap value. Total depreciation expense will be equal to the asset's cost less its salvage. The useful life of a plant asset is an estimate of the length of time it is productively used in the company's operations. Let's say that again. The useful life of a plant asset is an estimate of the length of time it is productively used in a company's operations. Useful life, also called service life, might not be as long as an asset's total productive life, but it's how long the company believes it will use the asset. Asset lives are often dictated by a company's experience over time. For example, the productive life of a computer can be 5 years or more. In some companies, however, trade in old computers for new ones every 2 years. In this case, these computers have a 2-year useful life, meaning the cost of these computers, less their expected trade-in values, is charged to depreciation expense over a 2-year period. Every company selects one or more depreciation methods to allocate a plant asset's cost over the accounting periods used during its useful life. 3 methods are commonly used to calculate depreciation. The most frequently used method of depreciation is the straight-line method. We learned about this method in Chapter 3. Another common depreciation method is the units of production method. We would elect this method if the life of the asset is generally measured in terms of units of production and varies from period to period. For example, airlines keep highly detailed tracking records of the number of hours the engines run. The unit of production may be the hours run by an aircraft. You might also see it used based on miles driven by a trucking company or packages made on a packaging machine. And finally, some companies use an accelerated depreciation method called the declining balance method. In this method, we take more depreciation expense in the early years of the asset's life and lower amounts of depreciation in later years. Several income tax depreciation calculations are based using the declining balance method. So let's begin by looking at straight line depreciation. The computations in this section use information about a machine that inspects athletic shoes before packaging. And here are some computations for you. Straight line depreciation charges the same amount of expense to each period of the asset's useful life. A two-step process is used. We first compute the depreciable cost of the asset, also called the cost to be depreciated. It is computed by subtracting the asset's salvage value from its total cost. And secondly, depreciable cost is divided by the number of accounting periods in the asset's useful life. We can state the periods in years or in months. If this machine is purchased on December 31st, 2014, and used throughout its predicted useful life of 5 years, the straight line method allocates an equal amount of depreciation to each of the years 2015 through 2019. We make the adjusting entry shown above at the end of each of the 5 years to record the straight line depreciation of this method, of this machine. The $1,800 depreciation expense is reported on the income statement among operating expenses. The $1,800 accumulated depreciation is a contra asset account to the machinery account on the balance sheet. A depreciation schedule is illustrated on this slide and is also shown in your textbook. A depreciation schedule is created for every single asset that a company owns. Now, usually, fortunately, they are computerized. They summarize the cost of an asset, how much depreciation expense is recorded for each period of an asset's life, how much accumulated depreciation has been taken to date, and the book value of an asset. Specifically, note 3 points in this exhibit. First, depreciation expense is the same each period because the straight line method has been used to depreciate the asset. Second, accumulated depreciation is the sum of the current and the prior period's depreciations expense. Remember, accumulated depreciation is a permanent account, and the balance increases every period the asset is depreciated. And third, book value declines each period until it equals salvage value at the end of the machine's useful life. Straight line depreciation means that the same amount of depreciation is taken in each year. The graph on the left side of this slide shows the $1,800 per year in expense reported each of the 5 years. The graph on the right shows the asset book value. Book value is what is reported on the company's balance sheet and is computed as the asset's total cost less its accumulated depreciation. For example, at the end of year 2, which is December 31st, 2016, its book value is $6,400 and is reported in the balance sheet as shown. Well, that's it for straight line depreciation, and when we come back, we'll talk about the units of production and the declining balance methods. See you soon.